All right, today we're digging into a really fascinating earnings report from the dairy giant Saputo. They just posted some massive profit numbers. But here's the twist, their sales actually went down. So how is that even possible? Let's get into it.
So first, just a quick refresher for anyone who might not know. Saputo is a global powerhouse. From the cheese in your fridge to the milk in your coffee, there's a good chance their products are in your life. They're a huge player, and you got to keep that scale in mind to really appreciate what they've just pulled off.
And that performance starts with this big number right here, Adjusted EBITDA. And all you really need to know is that it's a key measure of a company's core profitability. Well, it jumped a massive 18%. That is a huge, flashing sign that the company's fundamental operations are in fantastic shape.
And it gets even better if you're an investor. Adjusted earnings per share soared an incredible 46%. Whoa! That means the actual bottom line return for shareholders got a serious boost. So far, this all looks amazing, right? Now, this is where it gets really interesting for me. It's the how. Look at their profit margin. It expanded a lot. This means for every single dollar in sales they brought in, they got way better at turning it into actual profit. They're not just making more money, they're making money way more efficiently. And that brings us to the central puzzle, the thing that made everybody kind of scratch their heads. Profits are up, margins are up, but total revenue was actually down. How does that work? How do you make more money while technically bringing in less? Well, that's the mystery we're going to solve today.
We're going to break it all down. We'll start with the headline numbers, then get into their smarter operations, see how they're winning with customers, take a quick global snapshot, and finally, look at what's next for them.
Okay, first up, let's take a closer look at those key figures. This is where you can really see that paradox in black and white. And yeah, this slide just lays it all out, doesn't it? Look at that contrast. On the left, revenue dipped a little, but over on the right, profitability just shot through the roof. So what on earth could explain that drop in revenue when everything else looks so good? Well, the answer is actually pretty straightforward. The price of their raw ingredients, especially in the US, went down. Think of it this way. Imagine you own a coffee shop, and suddenly the price of coffee beans drops. You might lower the price of your lattes a little to stay competitive. So your total sales in dollars might go down, right? But if you've also gotten way more efficient at running your shop, your actual profit on each cup you sell could go way, way up. That's basically what Saputo just did, but on a massive scale. Okay, so let's get into the nitty-gritty of how they pulled this off. Because this, the operational efficiency, this is the real heart of the story. And this success was no accident. It's the payoff from a very deliberate, multi-year plan to completely modernize their business. They've been investing in automation, consolidating their facilities, and just relentlessly boosting efficiency at every single step. And hey, you don't have to take my word for it. The CEO, Carl Kaliza, said it himself. All that long-term strategic work is now delivering very real, very tangible results. You love to see a plan come together like that. So what does that actually look like? Well, here's a perfect example. They made the tough decision to close an older facility in Green Bay, Wisconsin. And then they moved all that production over to a brand new, high-tech, modernized plant in Franklin. And the result of that one single move? A mind-blowing 30% boost in output from that Franklin facility. That is what operational efficiency looks like in the real world. You're making more stuff faster and cheaper. This is the engine that was driving those huge profit numbers we saw earlier. But look, being super efficient in the factory is only half the battle, right? You also have to be winning on the grocery store shelves. And they really are. Big brands that you probably recognize, like Cathedral City, Armstrong, and Cheeseheads, are all seeing really strong growth. They're becoming staples in more and more homes, which just shows their products are hitting the mark.
They've also been incredibly savvy about jumping on one of the biggest consumer trends out there right now, the huge demand for high-protein foods.
And they are leaning right into it. You can see it in their new high-protein drinks and the absolutely massive growth they're seeing in cottage cheese sales. I mean, cottage cheese became this viral health food trend on places like TikTok, and Saputo was right there to meet that demand. This is about more than just selling dairy. It's about understanding culture and giving people what they're looking for. So we know the overall picture is really strong, but let's take a quick trip around the world and see how things looked in their different markets. The performance was just solid pretty much everywhere you look. In Canada, they had a second straight quarter of record profitability. They're just crushing it on home turf. In the USA, even with those pricing issues, they sold more product, which is a great sign. Their international sector was an absolute superstar, with profits soaring an incredible 61%. And then over in Europe, you've got solid revenue growth led by their really popular Cathedral City brand.
So after a quarter this strong, the big question is, what comes next? Where do they go from here?
Well, the CEO has been very clear that they're still in growth mode. He specifically said that M&A, that's mergers and acquisitions, is on the table. They're actively looking at buying other companies as a way to break into new markets and expand their reach even more.
And they are putting their money where their mouth is. The company is planning to spend over 400 million Canadian dollars in the next fiscal year on capital projects. This shows they're not sitting back. They're continuing to pour money into automation, efficiency, and fueling that future growth.
You know, this quarter was a masterclass. It proved that a laser focus on operational excellence can deliver absolutely incredible results, even in a tricky market. It's how Saputo turned lower revenue into higher profits. But it does leave us with a bigger question to think about. In a world that's so unpredictable, is just being the most efficient operator enough to guarantee success in the long run? For now, it's a strategy that is paying off, big time.